Good afternoon. Thanks for joining. I am super excited about this conversation. Obviously, as I'm sure you are, anything that has to do with the work that I adore and what we believe that we bring to the early education owner base is something I'm very passionate about and love to talk about. So, thank you for joining. We had a really big registration for this event. You might be joining later. You can certainly listen to this again and any other webinar that we have produced. They're available on our website. So certainly pick it up if you need another listen. But thanks for joining to talk about inside the seller's market, what every owner needs to know. So here's how I want to tackle this information. So let me frame up what we want to talk about today. What we want to talk about is, what does this market look like? And I want to go back and give a little history to answer that question. So in the 40 years I've been in the industry has been inflating in sophistication. Also would love to know if anyone else goes back that far, because you will know what I'm talking about. We have escalated in sophistication. We have stood up in very difficult situations, COVID, economic downturns, and proven that we are a necessary, robust, sophisticated industry that has the ability to navigate difficult situations, shift quickly, and find the opportunity in the sometimes chaos, or you might feel like your every day is a chaos. This is a very difficult industry to navigate in. So if you feel like that, you're not alone. We have specialized in bringing you smart, easy to follow financial concepts, but we are in a very opportunistic time to either grow or sell or gain an investment partner. So I want to talk through at different sizes of companies what your opportunities are, and then be thinking ahead also. Maybe I'm here, but what do I have to do to get to the next level or the next level and really reach my goals of serving more children, building bigger teams, creating more opportunity in the industry. So that's what really excites me, and it really excites people who look at our industry as an investment. Now, when I say that, and also you guys might have seen some negative information in the media about private equity investment in early education. Is that a dirty word? What should I know about that? I just want to say to you guys that my personal experience, and that is all I can speak to, is that every single private equity group who invests in the industry is not unlike how I hope you are. We are all business owners. We are no different from physicians and other medical professionals and other people who provide services. We are running a business. It's a mission? Yes, it is. We chose it because we believe very strongly in it, but also it is a business. We cannot serve people if we don't pay attention to the financial components of our business. That's exactly what happens with private equity groups. Do they want to make money? Yes, they do. I hope you do too, because you can't possibly do the mission you got in this industry for if you are not every day thriving. And I don't mean just your company, I mean you personally. You cannot serve as many people as you need to serve to do a great job if you are not thriving personally. So same thing, right? Maybe you know someone, maybe it's in industry or not, and maybe that someone put profits before people, and my guess is they're not in business anymore. Okay, so I have seen private equity investment in early education expand opportunities, give growth potential to people, go into new areas, make buildings more sound and beautiful, new curriculum, new. So I am not an alarmist with private equity investment in our industry. So I'm going to start on that level. I'm going to start on a high level of who might invest along all journeys of building a business. And I'm going to start on the largest level, which is largely private equity. What does private equity mean? Private equity means that an organization will take individual money, private money, and invest it in different businesses with a goal of growing that business to be bigger and more viable and more profitable. That's their mission, to help grow. So and I will say that we are a darling industry of investment from private equity and family house level money. You see that I have the word financial on my slide. So very often referred to as a financial buyer. You'll hear other terms as we go, and I'm not trying to, just throw around jargon to sound smart. I leave it out there because I want you guys to be familiar when it knocks on your door. Who is this? What are they doing? What is their goal? And how should I think about this opportunity? So at the very highest level, private equity companies are looking for mainly two things. There are more, but mainly the first two things mentioned here. So the first thing that they want is they already want a company that is cash flowing at a certain level. And so they are not looking for smaller companies. They are not looking for turnaround situations. They are looking for companies to invest in. Opportunities with that type of investment include perhaps I can exit. So some of them will consider that. We'll put new leadership in and use your platform as a launching pad. But more often than not, they really want a solid team led by a current CEO or founder that has the capacity to grow more. So typically our client, the seller, would sell a portion of the company, take some cash for themselves, and then work alongside the new investor partner 4 or 5 years-ish. They're different playbooks, but a typical playbook would be to hold an asset about 5 years, grow it bigger, and then exit, which creates a second exit for our founder at a higher value. They very often will bring in expertise and growth and site selection, development resources, systems resources. So they aren't just going to throw money at you. They will likely bring other areas of expertise to help you operate your company better. But the main thing they're looking for is a certain level of cash flow and a team they can grow from. In addition, they obviously, because they want a higher cash flow, it's usually a multi-site organization, and they're looking for schools that are capable of producing $2 million a year in cash flow. There's some variability there, and I don't really like to talk about it in terms of license capacity, although that is a gauge. Because a small license capacity in places like Boston, New York, California, some parts of Virginia, other places where tuition rates are pretty high, that school can have a lower license capacity, but still make a pretty big gross income. Schools in more normalized tuition rate areas might need to be licensed for 130, 150 and larger. So let me stop there and make a comment. Very often, I have the most wonderful team, guys. They are the most caring, amazing people you have ever met, and I'm so honored to work with them. And they would love, love, love to be able to help everyone do everything that they want. And I know you guys are like that too. You would not be in this industry if you were not like that. But just like a parent might come to you and you're very attached to their infant and they really need you to stay open an hour longer or open an hour earlier in the morning, and you would really love to be able to do that for them and everything for everyone. But at the end of the day, you're going to kill yourself trying to do that. So very often we struggle with having to say there is nothing wrong with your company. If you want to exit, there is an investor or buyer for every organization. But there are times when our particular buyer base isn't a fit for someone that we would love to help. And we have to give some amazing advice, hopefully, and help them find a different resource. So that's very difficult for us, but it happens. And so if you aren't at the place where you are a target for, I would say our first two groups that I'm going to talk about, private equity being first, and then larger national or super regional companies, they are amazing buyers because they already have cash. So you are not waiting for someone to go get a loan. They have people who are dedicated to nothing other than managing a growth transaction. They have legal agreements that are ready to go in a transaction. They have processes to acquire schools and transition people really, really well. That is so critical. And so hopefully one day you'll be in that arena when you exit. But if you're not, there is nothing wrong with your company. That just means it's a different buyer base. So sorry I got off on a tangent, but I really like the opportunity to speak to that. So they also would really love a company that has growth potential. So be prepared always to answer the question, if you could grow, where else would you go? And most people love a clustering of schools, and most buyers would like to be able to enter a new market with at least 3 schools and feel like they can cluster growth around those 3 schools. So they not only want to see the cluster, they want to know or believe that they can continue to grow by either building new schools or acquiring existing schools in that same geographic area. And the reason for that is simple. They need local support in the form of regional management, and they need to have enough scale in a market to afford that. So they're looking for growth potential. They're also looking for really great facilities. And let me say that I am not speaking about the age. I'm not saying that your facility needs to be brand new and compete with the next amazing franchise that's entering your market. But for a lot of reasons, enrollment and demand from parent groups and potential buyers or investors, you need to continually invest in your building, keep up with today's branding methodologies. I have been in buildings that were 20 years old that I thought were brand new. And our buildings take a lot of beating. Try not to use that word, but that's it, right? So continual reinvestment. Here's where we get back to financial viability and being able to invest. So at the very top of our investor buyer base, you have private equity groups or other financial groups looking mainly for cash flow, a solid team that knows how to grow, multi-site and larger schools typically with growth potential and nice facilities. So there's our first. There's the top. All right, let's go beyond that. All right, next, this group would be considered strategic groups. So I said strategies here. That's not what I meant. I meant strategic groups. So private equity groups are considered financial groups. These groups are termed strategic groups. That means they already operate schools. That's the only difference. So typically a private equity group that is entering with a platform does not already own schools. A strategic group does. Now, to avoid confusion, some strategic groups are private equity owned, but let's make that distinction. So in my first example, that was a new private equity group purchasing a company to use as its launch platform. In this situation, there is an infrastructure that is operating schools. They already have schools in some part or maybe nationally or some part of the country. Could be private equity backed, maybe not. There's still a lot of privately held companies. So that's something you should ask, but I'm kind of agnostic to whether they have private equity backing or not. But if they already operate schools, that's your distinction, then we will refer to them as strategic buyers. And those would largely be providers that already operate nationally. They might have 500 to 2,000 schools, or they might be what I call super regionals that have 50 to 500 schools, or they could be a bit smaller, but we'll get to smaller companies in a minute. So what are they looking for? They are looking for cash flow as well. They typically are not looking for turnaround situations or schools that are not performing, which is the same as private equity. They want to acquire what they feel like is foundational, proven cash flow that is at least as flat, if not increasing. They will probably back off if they see a downhill slope. So they are looking also for historic, stable cash flow. And what team are they looking for? They aren't necessarily, because they already have it, looking for top level teams, CEO, CFO, head of HR, things that a larger organization would have. What they are looking for is the team that is dynamic, that supports on the school level. So that's not only you're in the four walls of the school team, it could also be regional management. It's your maintenance team. It's anyone that bills subsidy, tuition, or the food program. It is, and this is kind of an industry change in the last, let's call it 2 years, but it's anyone that helps with hiring services on the school level. Maybe they do first interviews and they support directors that way. It's personnel who help arrange tours for schools, but so not upper level marketing, like let's put in an ad for a teacher, but it would be people who would do first interviews or direct billing, things that historically were happened on the school level, but right now there is a big trend to remove administrative functions from directors as much as you can, to set directors up to be able to focus almost exclusively on enrollment and customer experience. So we all know that so goes the director, so goes the school. We also saw some softening enrollments in the fall of 25. So not overburdening your director with administration to allow them to focus on enrollment and customer experience is sort of a must do now. Okay, so these groups are looking for that level of strength in the team. They also will gravitate, they will do single schools. It's got to be pretty dynamic, but they will. They prefer multi-site organizations and larger schools, like we mentioned. They want to know that they can grow that area. You know, if you are doing an add-on, you know, if we are doing an add-on into an area where the buyer already exists, not as important. But if we are putting a buyer into Georgia with 3 schools, their first entrance into the state of Georgia, they want to know that they can acquire or build more schools in Georgia. So growth potential is important. Same thing we talked about with facilities. Exactly the same thing. All right. I am going to real quickly scan our Q&A to be sure. Rule of thumb for distance between schools in a cluster. That is such a great question. I'm going to save it. It is a good one. All right, good. You guys keep dropping them in. Thank you for that, Laura. I will love to answer that. All right. So let's say that we are now entering the realm. We're going by size of company. I kind of hate doing this because it sounds like I'm doing better, you know, best, better, you know, medium. I'm talking about the size and the cash flow strength of the organization. So as we get on a more local level, so let's say that maybe it's an underperformer. Maybe it's an area with a little more risk associated with it. Maybe we've had some new UPK competition and we're have lost some children or some age groups. Let's say that we, for some reason, are struggling. We've had a director change and we know what that brings. So a local competitor might take on more risk. And by a local competitor, I mean a person who operates in your local area exclusively might want to grow. So they might take on more risk knowing the area better and feeling like they have a team that can expand in the area. They would look at stable school staff, but again, some of those would be willing to take more risk. And some of those are okay with schools that are smaller. So a local competitor, though, most people's issue with that is I don't really want to show my company to a local competitor. I get that. There are very easy ways to maintain confidentiality. We are very strict about it. We are just like fanaticals. We manage our processes so closely and with legal agreements that bind potential buyers with confidentiality. So we almost never have a breach. It's so rare. But people are nervous about that. I get it. I probably wouldn't want to send my financial statements to a competitor either. So we get that, but at a certain size company or a certain size school, that is the best option. So that's where we are there. And then some people prefer to think about someone new coming in and operating their school. Perhaps this is a director or a teacher or a family member or someone in the community who is not as experienced in the industry. Of course, the risk here is that two things are risky here. One thing is, does that person have the financial means to buy the school? So a lot of sellers find themselves financing part of it, which leads to the second risk, which is they have a higher degree of failure. And then especially if you have that financed, you may end up coming back in and running the school again. On the other hand, this works beautifully sometimes. And what those investors are looking for is more of a experienced, well-oiled machine. So they may or may not know how to operate a company or a school. They may need a more experienced team that they can depend on, and they may be willing to take more risk. So they will sometimes invest in schools that might not meet the size limit, or perhaps isn't performing quite as well. So those are my big buckets of different types of investors. So I'd like to speak to other things that investors are looking at that kind of sit outside of those four broad areas and that you can be thinking about. So other considerations, let's address real estate. So the majority of buyer investors will also purchase your real estate if that is your wish. We have never found it to be a barrier. And why is that? Because if they don't invest in real estate, and that is very often true by the private equity and national groups, their operating entity does not also invest in real estate, but they have real estate partnerships that will come together with them, present one offer to you, close simultaneously. They will work out a lease between themselves, and it's largely seamless. You'll know both things are going on, but it's not two separate processes. It's largely one process. At least that's how we manage that. So real estate can happen either way. And some people selling their business, they like to remain the landlord. And some people are like, check me out. I don't want that risk. Once the business is gone, I don't want to get the real estate back empty. I don't want to operate it again, just sell it. So real estate can be sold either way. And when we perform a valuation when the real estate is owned, we give a valuation also of the real estate. It's quite complicated, and that's next month's webinar, so I hope you'll join. Okay, to a lot of people, market demographics are important. So a lot of the larger groups want to be in certain average household income areas. They will also compare the number of children 0 to 5 to the available seats in that geographic area. And they will look at drive distance. So this is where I'm going to answer that amazing question, which let me just state it exactly. Is there a rule of thumb for distance between schools in a cluster? So there isn't a particular rule of thumb. If I had to give you an average, I would say for most people, 3 to 5 miles is far enough away not to compete. But if you go into an Atlanta, into a New York, in New York, it's a couple of blocks. If you go to an Atlanta, a Dallas, a Houston, a Los Angeles, then a mile is sometimes okay. And investors will look at whether they actually compete with each other or not. And it's largely built around drive patterns. So you can sometimes see one of your own schools across the interstate with a, interstate dividing it, and they really are two different markets, and that's okay. And then sometimes in some markets, they need to be 10 miles away. So it really depends on where a parent's working, what is the demand, will they compete from a convenience standpoint as far as drop off and pick up go? So great question. So that's where market demographics also play into that. Subsidy or universal pre-K. So there is the investment community considers a greater level of subsidy tuition or universal pre-K tuition, if you are able to play in that arena, to be more risky than private pay tuition. Now, if you look at the macro of our industry over 20, 25 years, our main source of subsidy tuition comes from the Child Development Block Grant Program, which in total has never decreased. But what we're experiencing right now is some states are beginning to increase the individual tuition rate, which they should, long time coming. What that does, though, is limit the number of children they can put on the program. So investors will feel like heavy subsidy, heavy UPK is more risky than private pay tuition. It's not a complete barrier. It does reduce the number of potential buyers or investors. It does not eliminate them. We work with companies with moderate subsidy all the time. So not a complete barrier. Information and record keeping. So investors go through a pretty robust process. I will say that I have, since COVID, never seen such an inflation in the difficulty of running a process from a financial verification and an informational standpoint as I have since COVID. Our team has doubled in size to manage the same number of transactions. So we now have 5 transaction advisors, 3 financial analysts who combined have over 100 years, believe it or not, in industry-specific financial work, 2 diligence managers, and a creative team just on our transaction side. We have put in new processes where we do some pretty in-depth financial verification before we even put a transaction out in the world, because we don't want them or us or investors to have surprises during the process. So keeping your information, record keeping up to date and clean is critical if you're moving into a process. Keeping your branding up to date. This is quite an investment. I always have to shout Better Beans branding because I think they do an amazing job focusing on our industry. And branding isn't just your logo colors, it is the way your exterior looks. It is the experience of the customer coming into your lobby. It is the tour stops and the way you answer the phone. And it is just so critical. It is an absolute necessity to compete in today's market. Investor buyers are going to look at your compliance history. They're going to look at your systems. We can no longer not be up to date on systems that manage parent billing, parent communication at the very least. And then your curriculum or program style can be important. There are some sizzle concepts like STEM, language immersion, Montessori, ratio, those are perceived very highly. Sometimes the more specialized they are, it will eliminate a couple of investors who don't know how to operate that type of company. But it will also generally command a higher multiple because it is considered a higher level curriculum. So those are other things to think about. And then lastly, in my content, just to note, if you're entering a process, then personal expenses that run through your company, perfectly accepted, perfectly fine. We are not the IRS. We are not judging you. Neither are buyers or investors. But be sure that you can track separately, substantiate the expense. I recommend using a separate credit card for it. You want to be able to show very clearly that something was personal versus business. I mentioned already an industry nuanced valuation. There are very specific things that we do. It is not just a give me your numbers, let me put it in to a pretty package, and that is the answer. It is not like that at all. We do a lot of work to strategize the presentation of the numbers to maximize the cash flow. What do I mean by that? We know that certain buyer groups are okay with certain expense eliminations. We know how to position rent if you own your building to get the maximum value either from a lease or the sale of your real estate. We know all the little nuances that position you well in the market. So industry specific nuance is very important. Pre-launch verification of key financial metrics. I mentioned this. Our financial team during a process goes through three very robust processes. We do a complete valuation of every company before we even talk about a listing agreement. We need to know we can meet your goals. You need to be happy with it. We need to be on the same page. We don't list everything. We want a 90% assurance that we can get something done. So we do that before listing. After listing and before launch, we do what we call a financial review of key financial data. And we have actually, in conjunction with our clients, stopped some launches at that point. If we found issues in the number, that would come back to lower the price later, because we don't want that for our clients. They certainly don't want it. And neither do buyers. They want to pay you the entire amount that they offered you. That's their goal. They do not want to find problems. And then in process, once we're under letter of intent for a buyer to purchase a company, they commission a quality of earnings process, which is like an audit. And our team leads that process of really digging in deep to the numbers. So it is quite the process. But that's something to be prepared for. Another thing to think about way ahead of any event is to work your way out of a job. I like to say that it's like being a parent. Our job is to have our children not be dependent on us at some point. Same thing with your team. You will be successful when your team does not depend on you for every question. PTO, so paid time off, is typically accrued by the team, and then they have the right to take it and you pay them for it. That is a liability in a company, meaning liability does not mean a bad thing. It means something that you owe. So they have earned it, you owe it to them. At the closing of the transaction, it's treated like any other debt that you owe. And perhaps the new buyer investor will take that over. They will pay it to them when they take it. but it is your liability that you would be required to pay the new buyer at the closing. So that's something to be sure you're coached about. You want to be sure that your facility aesthetics are beautiful, that maintenance is kept up to date. You don't want any issues in a building inspection. You want, I'm sorry, but a reminder just jumped up, which shouldn't have. No big deal. We can adjust. Copiers are something to think about, that larger companies that purchase schools will largely have a copier master contract and will not want yours. So if you have leases on copiers, very often the seller will have to buy those out or do something different with a copier. So begin speaking with your advisor well ahead of an event about what to do there. And then I'll end with build a team of advisors. So way before you're ready. I am not ready. I say they're going to have to bury me out back. But still, I have a dedicated tax advisor, a dedicated attorney, and if there was an industry-specific advisor that managed M&A companies, I would have that too, but I don't think there is. But us, we are happy to be your support system as you strategize your company. Begin to build those teams. You never know when an opportunity might come along that you will want to act on. So build a team of advisors. I am going to hop, before I tell you about next month again, I'm going to hop back over to my Q&A. What is the optimum subsidy to private pay ratio? Great question, Jeff. So it's almost never do we have zero subsidy, because even schools who don't focus on subsidy will probably have a teacher's child or a foster child, something like that, that is on subsidy. So absolute zero almost never happens. Then there is a level up to about 10% of your population being subsidy that almost every investor, almost every buyer is still in the same realm. They're still okay. They're interested. We're not compromising the multiple. When we get to the next level, which is about 30% subsidy, and why is that? Because at 30%-ish, you're usually able to participate in the USDA food program. Great revenue source. But between 10 and 30%, some buyers drop out, and that's okay. There are a lot still, up to 30%. When you get over 30%, it does not eliminate the opportunity, but it definitely reduces the number of investors who are still comfortable. One of the things that has changed in the last year is we're now having to drill deeply into the individual state and its UPK and subsidy program to really assess the risk and give information to buyer and investors about what a likely change might be or what we see coming. So to answer your question, the breaking points are 0, 10, 30, and above. And again, does not eliminate, just begins to reduce the number of investors who play in that arena. You know, they consider it not part of their mission. They consider it to be a little more risky, and you will see fewer, not drastically, but fewer investors in that arena. What is considered moderate subsidy? Okay, kind of the same thing, some moderate up to 30%. I love that, 30%. I'm a fan of the USDA food program, and who doesn't want that source of funding? Assuming the real estate is in a separate bucket, how do PE investors approach setting a cash flow EBITDA multiple of the 4 drivers? What is the relative importance of each? Okay, so if we are moving both the real estate and the EBITDA, we will model the operating EBITDA and burden it with a market rent. And so that EBITDA will be indicative of a company who pays the market rent, and then we will see the resulting cash flow. And if you think about that logically, that's what we're showing to the operations buyer. They are likely not going to also be the real estate buyer. So then the real estate buyer will look at that rent stream, and that is the complete basis of their decision on what to pay for rent for the real estate. So what they want to know, just like the business buyer wants to know what cash flow can I expect after I invest, the real estate buyer wants to know what rent stream, same thing, cash flow can I expect. And then I'm going to set that price determined by a cap rate, a capitalization rate, depending on what return on my investment I expect. So that's why we show this separately and combined to those groups that we do valuations for. So real estate separately, private equity investors are looking at the cash flow generated by the business, burdened by a market rent, and then the real estate value is based on that rent. Very good question, John. If we look at the 4 different levels of investors, they all look at it the same. They all have the same methodology. And as you get to smaller companies or individuals, they might want to control the business and the real estate, where you will see national, super regional groups and private equity companies they will have a real estate partner, but they all think about it the same way. Okay, so that was my last question. I'm jumping over to the chat. Anyone else want to? What about a mixed subsidy private pay type? Hopefully I addressed that for you, Kristen. Certainly you guys reach out as you process this information. It was a lot, but it was fun for me. So I hope you guys have fun too. Please reach out to the team here if we can answer any individual questions. If we can help you get registered for value. I know I keep talking about that, but I can't tell you guys how strongly I feel that if I had a place to go who gave me a valuation for an M&A company and allowed me to speak with other owners of M&A companies and gave me a whole day of content on how I would exit that if I wanted to, I would, go wherever they asked me to go. So we are just really excited about that as an opportunity for owners. So we would love to see you guys there. Reach out to us. You will get a copy of the recording. Reach out to us if you have any questions. Please stay in touch with the Hinge team, and thank you for joining us. Take care. Be well.